That does it for us today as we shake out the final trades. Looks like the Dow is going to close the day in the red, although well off the lows of the day. Looks like it's just off 6 points, so not moving too far from the flat line. S&P and NASDAQ, though, holding on to gains. And NASDAQ was the outperformer for most of the trading day, closing up just around 0.4%. The S&P up 6 points. Taking a look at some of those movers, Jared went over that a couple of minutes ago, but taking another look at it sector-wise, technology, healthcare, and materials are some of the outperformers in today's market. The worst performer is energy. We're seeing energy under pressure as oil closes in the red as well. Within the Dow, the worst performers in the Dow, Walgreens, 3M, and IBM. So some of the reasons there that we're seeing the Dow close in the red. We want to bring back in our guests. We want to bring back Jim Bianco and Jack Manley. And Jim, let me just go to you just in terms of the recent action that we've seen in the market. What's your take on it? And I guess, where are you seeing some opportunity right now?
Well, I think that the market has really been bifurcating itself quite a bit. There's been a big shift among investors. They have been moving away from the traditional products of active managed funds or even ETFs, and they've been going it on their own. We all know the Reddit story as well. But what we also have to remember is, for the moment, they're winning. They're winning pretty much everywhere that they go. Whether it was them buying airlines last spring after Buffett sold them, and then the airlines doubled after Buffett sold them, or running into all the non-profitable tech companies, or running up Tesla, or then with the short squeeze, I think that we're finding that there is a newfound investor out there, and that is the individual investor buying stocks on their own. And I think it's a twofold thing. One, there's a lot more risk tolerance there. I think the Fed might have something to do with that, telling them that they all have got their back. And I also think that there's a little bit of a frustration that the traditional products that they would buy aren't seeing the needs they are. They recognize there's a disruption going on. They recognize that there's going to be a big change in the economy, none bigger than the financial services business and the banking business is going to have a huge change. And they want to be part of that. And traditional investment products are just not giving it to them.
So, Jack, let's keep this going, because we talk about the Reddit retail investor phenom. But how do the markets, how do money managers and professionals, work that into your strategies? You got to deal with the high frequency crowd and the sharks in the dark pools. Now you got to deal with this.
Yeah, I mean, I think that's exactly the point, right? Is that this is just one more component to be added into the calculations, just as you had to add in those high frequency traders a couple of decades ago. I mean, 2020 created this monster, if it is a monster. You had a lot of idle time on the couch where you were pretty bored. You had barriers to entry when it came to investing being removed. A lot of these online brokerage services are essentially frictionless. And then you had a world kind of awash in money, ultra easy monetary policy, ultra easy fiscal policy, kind of the perfect storm for creating this retail investor. And their motivations may be a little bit different. Their access to information is certainly different, but their money's as good as anybody else's, and they're going to participate because they can. And so I think we need to just price this in moving forward. And the biggest takeaway, as you mentioned, is I think just structurally speaking, greater volatility in markets in the years to come.
So then, Jack, how are you hedging against some of that greater volatility? Just because there is another factor out there where we are seeing risk.
Well, as Jim mentioned, a lot of the names that are getting bid up for fun. They're not necessarily based off of the fundamentals. And so what I still think we can do as longer term investors is focus on those longer term trends. And technology and healthcare, we continue to believe, are long term secular stories. I don't think anybody can make a good faith argument that tech will be less important a decade from now than it is at the moment. And at the same time, we can start to lean into some of those more cyclical parts of the market, some of the laggards of 2020. Energy, maybe to some extent, industrials, maybe to some extent. But as always, and you've heard me say this before, I continue to believe large cap financials may be one of the best opportunities in markets right now. So I think there are still opportunities as long as you position yourself for the long run.
Jim, we've had other analysts on who've talked about financials being a good bet this year, 2021. I'm curious what you've set your sights on to, because there is this concern of inflation. There's this concern that some stocks, some sectors are overvalued at this point.
Yeah, I think going into 21, I've been pretty steadfast that the story of 21 is going to be inflation. Now, I'm in the camp that it's going to return in the second half of the year. I think all the money we've been mailing to people, the stimulus, it's finding its way into the equity market right now. But eventually, when the economy reopens, that money's going to come back out, and it's going to come back out in the form of spending, and it's going to push prices higher. Now, that's my story. If the other side of the equation is, look, we're going to send all the stimulus money out and there's not going to be inflation, that could actually be a bigger story, because then the monetary theory crowd wins, the universal basic income theory wins, and we have to go back to the basics of finance and rewrite it. And we're now probably going to see Mitt Romney's bill where we're going to be sending people money every month if they have children, and probably sending everybody else money every month. That's going to become the order of the day if we don't see it. If there is no consequence to sending people money, we're just going to keep sending it to them. Right now, the consequence is the poor get help, the unemployed get a bridge, and the rich, to find these equity markets, get new highs. So keep mailing checks. And I think we're going to keep doing that until we get inflation. And if we don't get inflation, we're just going to keep mailing checks and have to rethink our whole monetary theory.
Hey, Jack, what do you think the market is anticipating when it comes to inflation?
Well, when I look at inflation, I mean, I think there are certainly some pressures building to drive it higher, but there are long-term anchors in place when it comes to where inflation can actually go. You have the rise of e-commerce, online shopping. I mean, we as consumers right now have more price discovery power than basically any human being in the history of commerce. And then you have the rise of or a very large and growing, I should say, trade deficit with China. You have the United States coming online as a swing producer in global energy markets after the shale oil revolution. All of these things, I think, keep a lid on where inflation can go. So I don't think anyone is seriously pricing in, 10, 15% a return to the late 70s when it comes to the inflation environment. But is it possible that all of this money sloshing around in the economy right now starts to bubble up inflation in the back half of this year? I think that is entirely in the cards. But what that looks like is maybe breaching the Fed's 2% target modestly, rather than sort of shooting the lights out and getting into double-digit disaster-like territory.
I'm going to say thank you to our guests because we have Disney earnings. Jim Bianco, Bianco Research President, Jack Manley, JP Morgan Asset Management. Thank you both for hearing. Jared, what's